Good evening, everybody, and welcome to my live stream. My apologies that I am 2 minutes late. I had pretty major computer issues tonight, so I apologize for that. Hopefully everything's going to work out beautifully from here, but I wanted to get on as quickly as I possibly could. So I am right now launching my PowerPoint so that I can go through this. So if you will indulge me for a moment, I jumped on live on a new computer. My laptop was not cooperating, and so I had to switch it out to another laptop. But we're going to go ahead and get this going. I appreciate everybody for joining me tonight. So bear with me as I just generally get a little bit of housekeeping done. So Dream for All. Let me first of all give you a big picture while I am loading up my PowerPoint. So this program and the whole point of tonight really is to give you a big picture overview of the program itself, how it works, who qualifies, and really what you need to know in order to take advantage of this. The audience is going to be both real estate agents and consumers, buying in general, about the program and the process and what you can expect. So that's really my goal, is to help you to navigate these waters and figure out if it's right for you. So my PowerPoint is loading. I want to welcome, I have a couple of my colleagues on the call, so I'll be introducing them as well as we go through this, but I have James and Gustavo. James and Gustavo are loan officers with me, and they have brought in a lot of their clients and their realtors as well, and so I'll be providing their contact information here in a moment. I promise you I'm about 10 seconds away from being done with filler and being able to actually live launch what I want to tell you. All right, I'm almost there. Let's go here and share my screen. And here we go. Perfect. All right, now, woohoo, we're there. All right, beautiful. Thank you for indulging me for the last 2 minutes as I rambled on a bit. So again, John King with Summit Funding. My goal really is to educate you on Dream for All and help you figure out if this is a good decision for you or not. I am going to really dive deep into this program, but give you the high level to start with on, is it a good idea? And then go deep into who qualifies and is this a good idea for you? So let's go ahead and get started and make this happen. All right, so let's get on to our next screen. Our agenda. So what is California Dream for All? When is it coming back? What do I need to do to prepare for this release? And should I wait or should I buy now? So a lot of those things we're going to cover tonight. We're also going to have some time for some Q&A. So I'll be covering that for you as well. All right, so let's dive in. First of all, meet the team. I mentioned earlier, I have James Lungi and Gustavo Martinez. So both of them are here to help you out. So between the three of us, we are here to take great care of you. If you were referred by a realtor, your realtor would have connected you through one of the three of us, and we would love the opportunity to have that person serve you through this process. I do want to remind you that this is an interactive conversation. So if you have questions about anything I'm saying, post it into chat. If you're watching in the webinar, there is a chat in the webinar. If you're watching via live stream, you can see the chat, put any comments into the live stream on the platform that you're watching, and I can see those as well. So I appreciate some of you that have already put in some comments, and let's go ahead and keep going. What is California Dream for All? First of all, it is the single best down payment assistance program I have ever seen in my 23-year career, but it's not right for everybody. It's a program that gives you a huge amount of assistance, but it comes at a big cost. So it is basically what's called shared appreciation. Think of the state as your partner in buying the home. You're buying 80% of the home, they're buying 20% of the home. So it's critical to understand the state is basically partnering with you in purchasing the home. And when you sell it, they're getting 20% of the proceeds, or not proceeds, they're getting 20% of the sales price. You're getting the other 80%. They invested 20% of the purchase price, they're getting back 20% of the sales price. Now, if you can afford to do this on your own, you're going to make more money because you get to keep 100% of the appreciation. But for a lot of people, this is the only way they're going to be able to purchase a home given today's interest rates and given today's house prices. And so this program is going to allow you to do that. And for anybody who knows about this program from last year, it was really challenging to get into the program. I actually helped 9 people last year get into the program, and it was very hard because the rules worked different last year. They fixed a lot of those things. They made it a little bit more challenging in some ways, and we're going to go through all of that right now. So the first thing I want to cover is, how does shared appreciation really work? What you see here is a simple example. I'm going to make this bigger so you can see it a little bit easier on the screen. What you see here is a simple example of if you purchased a home that's worth $500,000. The state is giving you $100,000 as a loan. It's not a grant. It's not a gift. It's not free money. They are buying $100,000 worth of your home price, yet you're the sole owner. You get to make all the decisions on when you sell. You get to make the decisions on what you sell it for. But 5 years later, let's pretend the price goes up to $640. You sell the house, you've made $140,000 in appreciation. Well, the state gets the original $100,000 they gave you plus 20% of the appreciation, or $128,000, which is just plain 20% of the price that you paid when you sold the home. Now, I've got a quick question here, Manuel. I'll pull up your question. You asked if after a couple of years, I decide to move into something else, are allowed to keep the property and rent it out. Officially, there's nothing prohibiting you from doing that. The state says, well, if you're not going to live there, we'd like you to sell it or refinance it so we can have that money to give to somebody else. That's what they say. But in writing, you don't have to. So what you have to do is move in within 60 days, and you have to stay there for at least a year. That's what you're signing as an occupancy certification. After that, you really have all the choices on what you want to do. So hopefully that helps answer your question. F Sharp, good to see you again, my friend. Under this program, what if the appraisal is short of the sales price? Okay, so we're going to loan you the state is going to give you 20% of the lesser of the purchase price or the appraised value. I'll pull the question back up here. So the state is going to loan you 20% of the lesser of the purchase price or the appraised value. So I'm going to use simple math here and say on a $500,000 priced home, and you are getting $100,000 from the state, and you're borrowing $400,000. And now the house comes worth $450,000. Actually, $480. Let's call it $480. So the house is worth $480. So now the state is only going to loan you $96,000, not $100,000. But I can keep the loan amount where it was. So essentially, I can still loan you $400,000 on the first mortgage, as long as that doesn't exceed 85% of the home value. So the simple way to do this on the fly without being able to write out the answer to it is, as long as the value doesn't come in more than 5% below what the contract price was, then you can ultimately still buy the home with the same structure we were looking at with 0 down payment, because we can and that's assuming you were paying your own closing costs. I don't know that I helped answer the question. I am positive if I try any harder to answer the question, I'm going to make it more confusing. So I'm going to move on and simply say, if the value comes in less than the contract price, then the amount from the state drops to 20% of that number, and then we figure out if we can make the first mortgage big enough to cover the difference. Hopefully that helps and didn't confuse things even more. All right. So when you sell the home, you're getting 80%, the state is getting 20%. So I hope that makes sense. I've gone through this slide many times in my prior presentations. It's all over my YouTube channel. I'm not going to dive too deep into this. All right. And F Sharp says, yes, it did answer his question. So glad to hear that. All right. Now, so you're selling the house for $500,000. Excuse me. You bought the house for $500,000. You're selling it for $640,000. You get $142,000. I don't think I went through that well enough, so I'm going to go back here really quick. When you sell the house, you're getting $142,000. You're saying, John, that doesn't make sense, because the house price went up by $140,000, and I gave the state $28,000 of what it went up. How in the world am I walking away with $142,000? Because you've paid down the balance on your mortgage, and that balance on your mortgage means it dropped from $400,000 down to $370,000. So you picked up an extra $30,000 in equity, not because the price went up, but because you've paid down your balance. So hopefully that makes sense. And then the state recycles this money, so they loan it to somebody else later, but it's going to take, I think, 4 or 5, 6, 7 years before of consistently funding this before we're going to see recycled money. Because even if some people, and by the way, some people have already paid off their Dream for All money from last year, but even at that point, there isn't enough to put into a pool to create a new fund. They're just throwing it into the fund that we have right now. But if there's no new money next year, then there's no money to put back to, they're not going to relaunch a plan unless they have enough money to make it worth their effort. All right. When do you pay it back? I get this all the time. People say, John, I am super happy about this program because it is free money. It's a grant. I don't have to pay it back. Or I'm going to keep the home for 30 years so that I never have to pay it back. You always have to pay it back. You will always pay back the state. It's when you have to pay them back. First of all, you can pay them back at any time you want. If you win a small lottery or an inheritance and you want to write them a check, you can pay them back. You are buying out your co-owner at any time you want. For whatever the house value is at that moment, they get 20% of that. But when do you have to pay them back? When you sell the home. So you pay 100% of the real estate fees and the other closing costs, and the state gets 20% of the gross sales price. When you refinance the home, now you can refinance once. This was true last year, and it's true again this year, that when you refinance the home, you can refinance one time without pulling cash out, and you don't have to pay back the state. But you may want to. Let's pretend that rates right now are at 6.5, and you end up refinancing down to 4.25. Well, you can actually refinance and bump your loan amount to pay off the state, and you can wash your hands of your silent partner so that you don't have to keep giving them a percentage of the future gains on the home. Or in 30 years, when you pay off your primary mortgage, you have to pay back the state. And CalHAF will order an online valuation, and you have to write them a check for what you owe or get a new loan at that time. So you can get a loan to pay back that appreciation loan because you finished paying off your primary loan. I highly doubt anybody's going to keep their loan for the next 30 years, but that is what would happen if you chose to. So is this a good idea? I'll tell you what, there's some really good reasons. You're only making payments on 80% of the price, and it offsets the affordability issues because obviously rates are high, inflation is high, you're paying high cost for a lot of stuff, and there's no mortgage insurance provided you're paying your own closing costs. So I'll show you some numbers, give you an idea of how it works here in a minute. You can buy a better home. Let's say you're qualified for $500,000, but you really need something of a higher price. Well, you could buy a $600,000 home with a lower payment than what you were going to spend on a $500,000 home. So it's a great way to let you stretch your purchase price, or buy a price home that you're already comfortable with, but have a lower monthly payment. And finally, you get to stop renting. You don't have to worry about your landlord coming after you and saying, hey, you got to raise your rent, or hey, you can't put that on the wall. You can do anything you want because it is your home. You put down roots for your family. You put down roots for future generations. Generational wealth. The average homeowner is 10 times more wealthy than the average renter. And that's actually what the state was looking at when they created the program guidelines for this second round, is they said, look, we've got to help fix the gap between families that pass along wealth from home ownership and ones that can't get out of the cycle of being renters. And so it's a big change for this year. So here's some of the cons. You don't get as much money when you sell the house. You pay 100% of the cost of selling the home. Even though the state gets 20% of the proceeds, you're paying 100% of the cost. And you can only refinance once without triggering a repayment. Well, why is that a big deal? Because if rates are at 6.5 when you get the house, and they drop to 5.5, it's a good deal to refinance, except you only have one opportunity to refinance. And so if you refinance at 5.5 and then rates drop to 4.5, well, now you can't get out of that loan unless you pay back the state. So maybe you don't refinance at 5.5 and you wait for it to go to 4.5. And what if it never goes to 4.5? And now you've been paying 6.5 for a lot longer than you need to. In other words, it creates kind of stress to say, when do I refinance? Now, I'm here to guide you. I'm here to help you. By the way, James, Gustavo, and I are here interviewing for the job to be your lender. So if you find this video accidentally, please make no mistake. We are interviewing for the job to be your lender, whether you do a loan via Dream for All or you use a different program. We are absolutely interviewing for that job to be your lender. All right. So let's talk about some success stories really quick. I helped 9 families personally last year with Dream for All. I'll give you some examples. I helped a family in Pacifica with a $1.225 million home. Now, this was last year's rules when you could get 20% of the purchase price, and they had the 20%, so they got $245,000. And we used that to pay for their down payment. We used that to pay for their closing costs. They got back their earnest money deposit. They got back their appraisal fee, and they actually got $97 back as a principal reduction. In other words, we made $97 towards their first payment because we had the numbers lined up so perfectly. Now, that's not going to happen at that price range this year with that big of money, but the same concept can be true. We can still make it happen for you. Here's another family I helped in Stockton. They bought a $397,000 home. They used the 20% down to pay their down payment and all of their closing costs. So when you buy a home, you have to put a deposit. You have to pay money to the title company to say, I'm serious about buying this home. And so they paid a $7,840 deposit. We covered all their closing costs, their credit report, their appraisal fee, and we refunded their deposit to the tune of $7,737. They literally only needed $102 in the end to buy the home. Now, they had to front the money for the inspections. They had to front the money for the appraisal. They had to front the money for the earnest money deposit. So remember that if you're looking to use this program, you have to front all of that money. We can get it as a gift from family if you need to. But if we structure it right, and I'm really good at structuring these, we can get you almost all of that money back. A couple more stories. I helped a client in the Los Angeles area buy a $1.05 million home. Now, this client used 20% of the state funds towards the down payment. Again, this year, you can't use 20% on that price, but he got over $200,000 and he paid his own closing costs. He decided, I want to use more of that money to pay towards down payment, and I paid for my own closing costs. Here's another client, the last of my success stories, bought a $397,000 home in Lodi. They put 5% of their own money plus the closing costs, and they decided they only wanted 15% of the money from the state. So they put 20% down, but they didn't take the full 20% from the state. They took 15% from the state. Now, why would somebody want to do that? Because this client only needs to pay back the state 15% of what the value goes up, because their silent investor, the state, only bought into 15% of the price of the home. So that they only have to pay back the state. So for some of you that say, hey, I want to put in 5% of my own money plus closing costs, it might make sense to only take 15% from the state. 5% from your money comes up to 20%, so you don't have mortgage insurance, and you pay your own closing costs. That way you're paying back less money to the state. So what were the rules the first time home buyer, which is continuing. No co-signers, which is continuing. You have to have a 680 FICO score or 660 if you meet the low income rules. That is continuing. Fannie Mae conventional only. So if you are approved on FHA, it doesn't work for this. If you're buying using VA, it doesn't work for this. You have to meet Fannie Mae's conventional guidelines, and it must be owner occupied. I know that we had the question from Manuel about what happens if you rent it out later, but right now it has to be owner occupied. With the original rules, you were allowed to combine up to 30% of your own money. No more. You're only allowed 5% of your own money. The thinking is they don't want people who have their own money for a down payment to tap into this money. Now, they're not saying you can't have the money, but you can't use it. If you had enough money to cover more than 5% down and you're willing to put more than 5% down, the state said, then you can't touch our money because we want to reserve that for the people that don't have the money to pay their own down payment. By the way, the rules were on a bankruptcy. If it was a Chapter 7, you had to wait 4 years. And on a Chapter 13, you had to wait 2 years. Those are still the rules this time around. You also need to be 7 years after a foreclosure. That rule has not changed unless the foreclosure came after a bankruptcy. Weird little rule there that we can get into one-on-one. So when's it coming back? It's coming back in April. So they have not given the dates, but they've said in April, the reservation portal is going to open. I'll give you more details about that in a second. They have $255 million, which is about 1,700 to 2,000 families. So I've talked to the state a couple of times. I've dug in, listened to their webinars, listened to their board meetings, and asked a lot of questions on these webinars. And here's what I've come to understand. The state is going to open up the portal in April. They're going to select 1,700 to 2,000 people, depending upon how many people they can fit in based on how much money people are asking for. And then they're going to send vouchers out to those people in May or June. It's a lottery system. Actually, let me get to that in a second. So the change is lottery system. So you're going to have, we think, 90 days, maybe 120 days to shop for a home and secure that home. And actually, I'm not sure they're going to match the demographic pool. They are absolutely matching geography. I'll explain geography in just a minute. I've gotten some mixed answers on whether they're going to use any other criteria other than geography. They are making it needs-based, which means you cannot put more than 5% of your own money for a down payment, and they're capping how much money you can get. So the most one person can get is $150,000. In other words, you get 20% towards your purchase price unless your price is over $750,000. If it's over $750,000, the most you can get is that $150,000. Okay, so I want to talk really quick about the lottery system and the lottery process. So what's going to happen is, actually, I haven't covered it yet. I'll cover it in a minute when I talk about the first generation home buyer. So what's going to happen from the lottery perspective is it's based on geography. So they are going to distribute the money proportionate to where you live when you apply, not where you're buying. So you can buy anywhere in the state, but they're basing this on where you live when you apply. So if you look right up here in the northern area, we've got rural areas, and the rural areas on the eastern edge up against Nevada. That together is 4% of the state population. That means they're going to give 4% of the money to those areas. The capital region is 6% of the state's population. Central Coast is 6% of the state's population. Central Valley is 10. Inland Empire is 11. And then we get San Diego is 9. Orange County is 8. The big ones are the Bay Area is 21% of the money is going to the Bay Area. 25% of the money is going to Los Angeles. Now, this is how the money was actually spent the first time around. You notice that, and I'll make this bigger so you can see it. Here we go. All right. So what you'll notice is, actually, I'll make it really big so you can't even see me. I'll put myself in the corner. There we go. Perfect. All right. So what you see here is that the coastal areas got less money than their population, especially in Southern California. Los Angeles County, 25% of the state's population lives there, but only 9% of the money went to Los Angeles County. The state is fixing that. They said, we are only going to provide the percentage of the money based on the percentage of the population. And so if you live right now in the Central Valley or in the capital region, you have a lot more demand, a lot more people wanting to use this money. Why? Because prices are lower. But they want to make sure that they keep the money focused on the regions where the population lives. And so they're really focused on driving this into the coastal areas. And I think it's going to be hard. I've talked to a lot. I have so far 43 people that have applied, given me income documents, and allowed me to pull credit so that I can help them get their Dream for All pre-approval. So with those people, I will tell you a large portion of them are in the LA area because that's where a big portion of the money is going to go. All right, so let's talk more about the lottery system and how it's going to work. Well, income limits first. Oh, you know what? I didn't cover that. All right. So did I cover it in here? Hold on, guys. I hope I had the right presentation. Yep, perfect. I do. Good. So reduced income limits. They lowered the income limits from where it was last year. And I want to show you the income limits. This is super confusing. So what we're going to do, I'm going to go right here, and you should. Nope. You can't. All right, I'm going to fix this. I'm going to reshare again. Stop sharing. Share again. Share my screen. Share the entire screen this time. Perfect. All right, so we're going to go to the state's website, so Cal HFA. And once we're on the state's website, we are going to see, once it loads, we're going to see right here, California Dream for All. And we can go to home buyers. and you'll be able to get all of the information that you need about the Dream for All program right here. Now, hopefully you're getting everything you need from me through this presentation, but the fact is you've got all the process, the next steps, the eligibility, everything that you need, including what steps you have to take to qualify, okay? What you'll see here is they give you the same examples that I've just gone through, but you also, I'm pretty sure on this version, well, let's go to the lender version, because there's a spot, you can go to the lender version even if you're not a lender, okay? There is a spot where we can see the income limits. And so if we go to the Dream for All Shared Appreciation Handbook, you can actually read through all the guidelines if you want. But what it's going to take you to is the income section. So if you don't know what the income requirements are, the income requirements are right here. And what we're seeing, up or down, here we go, income limits here, and you're going to see, man, this should have come a lot easier. They got to make this easier to navigate. All right, so income limits for California Dream for All Shared Appreciation Loan. I think I'm finally getting the page I really wanted to get to. All right. Again, my apologies, we weren't here at the beginning. I actually had to switch out my laptop to a different one. And so this was not the laptop I had intended to present on. But here are the income limits. So this is the most you can make in the county that you are buying in. Don't confuse that with where you live. So your selection is based on where you live. So if you live in Los Angeles County, the most you can make is $155,000. But that's only if you're trying to buy in Los Angeles County. If you live in Los Angeles County and you make more than that, then you can look at a neighboring county. So you can say, hey, John, can I buy outside of my county? And the answer is yes. You could buy in Orange County and the income limit is $202,000. But the opposite doesn't work. You can't live in Orange County. Now, you live in Orange County, you make $180,000. You're like, great, John, I'm good and I'm qualified and I was selected for my voucher. Now, you said I could buy anywhere in the state, and you can, but you can only buy in places that your income meets. So you make $180,000, you can buy in the Sacramento area, but you cannot buy in San Bernardino. You cannot buy in Riverside County because you make too much money for those counties, and you cannot buy in Los Angeles County. So even if you said, John, I'm qualified, I make less than the limit for the county I live in, and you said I could move somewhere else, you can. But you have to meet the income limit of where you're moving to. And then you also have to meet the lending guidelines, meaning your income has to be portable, or it has to be within a reasonable commute distance. We won't let you move from Orange County to Sacramento on a job that you have to drive to work every single day. Okay, Arnold Schwarzenegger did it the opposite. He lived in LA and he worked in Sacramento at the Capitol when he was the governor, and he flew a plane to work every single day. We don't believe you're going to charter a plane and fly it to work and home every single day and every single night. So we will not allow you to do that unless your income is portable, such as you are a remote worker or you travel for work, then it's no big deal. Okay, so let's get back. Let's keep going here. Income limits. This is the biggest change, and this is the most confusing thing. First generation home buyer. I'm actually going to move past what they said originally. So the first generation home buyer really, and I apologize, but the presentation I'm using right now was one that I created before the actual rules came out and what I was expecting the rules to be. And so I am going to go, here we go. All right. So here's the actual rule. The rule says to be a first one borrower. So if you are buying with somebody else, then one of the two of you has to meet this criteria, which is that you personally have not had your name on any home in the last 7 years, including co-signing, including just being on title. You can't have anything to do with any home in the last 7 years. And your parents cannot own a home today. Now, why does that matter? Because they're trying to keep the money focused towards people who are first generation home buyers that aren't receiving generational wealth from your parents. Now, there's a lot of weird situations where you say, yeah, but I'm not getting that money from my parents. The state had to draw the line somewhere. And so they're simply saying, hey, if your parents are alive, they cannot own a home today. If your parents have passed away, they cannot have had ownership in a home the moment they passed away. So at the time of their death, did they own a home? If the answer is no, you're fine. If they're alive, do they own a home? If the answer is no, you're fine. But only one of you needs to meet that criteria. Both of you have to meet the criteria. All people on the application have to be California residents, and you have to be a first-time home buyer, which is that you have not lived in your primary home anytime in the last 3 years, or lived in a home you owned. You haven't lived in a home that you owned at any point in the last 3 years, or you haven't lived in a home owned by your spouse at any time in the last 3 years. So it is very, very confusing. You're going to want to schedule an appointment with myself or James or Gustavo to talk through your particular qualifications to determine if you are in fact eligible. But one of the biggest questions I get from people, I'm going to close this out here real quick, is, John, how do they validate all of this? How is the process going to work? So let me explain to you what's going to happen. The next step, once we're done with this webinar and you decide, yes, I want to move forward, you will contact me, you'll contact Gustavo, you'll contact James, and you will say, I want to start the process of getting my Dream for All pre-approval letter. We will pull your credit, we'll take a look at your income, we'll take a look at your assets, we'll run it through the system, and we will give you the pre-approval letter. In April, the state will open up a reservation portal. This is critical. Hear me out, because this is one of the first times I'm saying this. The state has made it clear, one application, one entry into the reservation portal per household. So if you currently live with your sister and your sister are both looking to buy homes separate from each other, one of you better move out really quickly, because at the time that you submit your reservation into the portal, they're going to double check to see if there are any other reservation requests from anybody living in your household. If they find a duplicate reservation request, they're tearing them both up. Yeah, they're tearing them both up. They're not playing games. They want to make sure that people are not trying to game the system. And so if you are thinking, hey, I qualify on my own and my spouse qualifies on their own, and so one of us will buy and we'll buy on our own, because that way we don't have to worry about the income limits because both of us are below the number. That's all great. But only one of you can submit a reservation request. Because if they find the duplicate, they're not just getting rid of the duplicate, they're tearing both of them up, basically discouraging people from even trying to submit duplicate requests in the reservation portal. That's critical to understand. All right. Now, how are they going to make sure that somebody's not lying about their parents being about the parents owning a home? Here, by the way, there's one more rule I didn't mention. If you ever spent any time in foster care, you do not, hear me out, you do not have to worry about your parents owning a home today. You don't have to worry about whether your parents owned a home at the time that they passed. If you spent one day in foster care, but they're going to ask for proof. They're going to ask for your foster care certification letter. I don't know if that's the right term for it. Justin, I see your question, so hold on one second. I'll get to that. So the fact is they are going to validate whether you're a first-generation home buyer by hiring a private investigator to research. They are going to dig into every single person. Now, I was worried on a few of my webinars I've done, I was worried, how long is it going to take them? Because they expect 20,000 or more people submitting requests into the portal. And they only have between 1,700 and 2,000. That means you have a less than 10% chance of winning. Now, the state lottery, people spend money on that every single week, and they have way worse odds. You got pretty good odds when you look at it compared to the state lottery, but you have less than 10% chance of winning. And you're going to have over 20,000 people that are requesting a reservation. How are they going to do an audit of every one of those people? Well, it was explained to me. What they're going to do is they're going to actually pick double the number. So, for example, if 2,000 people are going to get a voucher, and Los Angeles County has 25% of the state's population, then what's going to happen is they're going to pick 500 people from Los Angeles County plus 500 more as a backup. So they're going to come up with a total of 4,000 people, between 3,400 and 4,000 people. Okay. Aruna, I'll cover your question. Guys, put your questions in there. I'll get to questions in a minute. So they're going to basically take the number of vouchers they expect to provide, and they're going to pull twice the number of people. Before they tell you your name's been selected, those people go through the private investigator service. They expect 40 to 50% of the people that apply to be rejected. People that put their name into the reservation portal will be rejected. They are really afraid people are going to try and game the system. So their plans are, hey, we're going to pick 500 people in Los Angeles as the winners and 500 more as the backup. And they think of the 500 winners, they're probably going to have 250 that they have to throw away. And of the 500 backup, they're going to have 250 that they throw away, and the other 250 become winners. But they still have to get 500 more as a backup. That process is going to take, I think, a month. Now, they're not going to validate 20,000 people, but they still have to validate. They have to find 4,000 voucher winners, and they expect to throw away 30 to 50% of the people, which means they have to go through 6,000 to 8,000 people doing background checks or private investigation research to see if you're really telling the truth about being a first generation home buyer. So that's really, really critical to understand. Then and only then will they notify you as one of three groups. You have a voucher, you're on the waiting list, or you're not selected. Now, I'm happy that they're not making everybody be on the waiting list. The waiting list is only going to be as deep as the original amount of people selected. So if in your county, there are 200 people that are going to get it, then 200 winners and 200 people on the waiting list. All right. Once you get that voucher, that's when you start shopping for a home. That's when you meet with your realtor and start writing offers. And that's when you lock your interest rate. So interest rates are not locked between now and then, which takes me to the question that Justin said. What if our income goes up in April that goes beyond the county limit? So Justin, lots of things can change between now and April. Here's the problem. I'm pre-approving you now, but that is not your final approval. You have to meet all of the guidelines at the time you go into contract on a home. So that means that your income cannot exceed the income limits. Now, here's a little bit of news. The income limits update every year in June or July. So I would expect that the state is going to update those income limits in June or July because Fannie Mae creates the income limits and they publish them in late May. Actually, they create them in late May. They publish them in early June. CalHFA historically has taken 3 to 4 weeks to publish their version of those numbers. So I actually expect that the state will update their numbers. This is the first time we've had a critical program like this at the same time that the annual limits are updated. But I don't think they can wait. I think they legally have to update it. So there is a bit of a benefit here that I expect the income limits to go up. Technically, they could go down because Fannie Mae sets the income limits. It has nothing to do with CalHFA. But the simple answer to what we're talking about here, Justin, is you have to meet the rules at the time you're buying, and you have to meet the rules today. And we have no idea exactly what your income is going to be at that point. We have no idea where interest rates are going to be. We don't know where house prices are going to be. And so this is surely a gamble, but it's not costing you anything. It's a gamble that only has wins, only has positives on the other side. For a lot of people, there are going to be things that are going to come up, like a pay raise that you think is good. So if you're qualified for this program and you are right close to the income limit, you want to kind of not ask for that pay raise. You want to talk your boss out of giving you or postponing that pay raise. Justin, I've got multiple questions in between, but I'm going to jump to Justin's follow-up question. Justin said, my spouse hasn't had a job until March, but she starts working in April. It's going to put us above the income limits. Not necessarily. There are ways I can appropriately and legally ignore income. There are ways, first of all, you don't have to apply with your spouse. You can leave your wife off of the loan if you wanted to. Now, I'm going to stop for a second and make this really clear. If you buy without your spouse, then your spouse cannot be on ownership, on title to the home ever until you pay back the state. That can create a pretty serious estate planning issue. That can create a pretty serious issue where you pass away and now your property that your spouse lives in a community property state like California, and they have to go to probate to get the court to award it to them. So there's some things we can do with the living trust that you'll want to talk to me about so that you can put the property in your living trust that makes the property belong to your spouse if you pass away first. But to go back to Justin's question about income and spouses, I have a lot of people who say, John, I don't qualify because together my spouse and I make too much money. Well, depending upon the nature of the income, we don't need to show that job. If that's a recent job, we don't need to show that job, or we would remove that person from the loan. So some income by nature, we won't have to count because it's a recent job. And sometimes the rules work in our favor when it says you can't use income. Well, that's great. Then I can't use her income because it's a recent job. But if we have to show her income, then I can always remove her from the loan. Just understand you have the issue with estate planning. All right, so Aruna had a few questions. Can son and mother buy together? Absolutely, but one of the two has to meet the first generation home buyer rule. And so either you or the mother or the son has to be in a situation where their parents do not own a home today or didn't own a home when they pass away, or when they, if they're deceased, when they passed away. So yes, you can do it. It just gets confusing on, well, wait a second, if I'm buying with my son and I'm their parent, well, but you have to be a first generation home buyer yourself. But is your son's other parent a homeowner? That could exclude them. So that's hopefully helps explain that part. Your second question, they need an application now or wait. Everybody should submit an application now because we need time to make sure that you're qualified. Now, we're taking a few days to get you approved, but I'm more worried about what if there's something about your approval that we have to fix, something we have to work on to improve. We need time to do that. So the sooner you apply, the better off you are, because if there is a hiccup, I've already had a couple clients with hiccups, that they've got to do some work fixing their credit, but they have 2 months to work on fixing their credit. Imagine if they came to me on April 15th. Hey, I want to use the program. That's great. You have 2 weeks to fix something on your credit. That would be horrible. And then Aruna asks, how much is San Joaquin County? San Joaquin County's income limit, I believe, is $159,000. I closed that screen, but I think it's $159,000 in San Joaquin County. All right. And then last question before I dive back to my presentation is George asks, a single buyer that has parents that own a home is not eligible. That is correct. So if you are buying by yourself and one of your parents owns a home, like if one doesn't own a home, that doesn't solve the problem. Both of your parents need to not own a home right now if they're alive, or if you spent any time in foster care. Otherwise, in the eyes of the state, and it was the state legislature that wrote this, not the California Housing Finance Administration, but in the eyes of the state legislature, they say you're gonna get the benefit of the wealth that is passed on when your parents pass away. They own a home. They have wealth that came from home ownership. You're going to get the benefit of that. Therefore, we are not going to allow you to tap into this money because we're reserving it for people who don't have inheritances. Man, they don't have inheritances waiting for them. So that's really what the state is looking at. All right, guys, keep asking questions. That is what I'm here for. All right, so we talked about first generation. How can the funds be used? 20% for your own down payment. You get 20%. You can use that for down payment and closing costs. You can add your own down payment to it, but really take only what you need because you pay back a percentage of what you took. All right, Justin has one more question. Let me answer his question really quick here. To be more specific, my spouse has been a student for the past 2 years and didn't have any income. Do I need to include her when we apply in April, assuming we win the voucher? Well, we need to apply before you win the voucher. You have to apply. I have to take your application. I have to approve you now. If you're applying by yourself, then it doesn't matter. But depending upon the nature of her work will determine whether or not I have to include that income. So that's really not something I can answer in a forum like this, but I'd love to talk with you more specifically about it. At the end of the presentation, you'll see our contact information again, and you can reach out and schedule a meeting with any one of the three of us. We would love to help answer that question for you. All right. Again, you can use it to increase your buying power or to lower your monthly payment. So let's look at the numbers really quick. Let's look at some examples of how these numbers play out. And let me make this bigger so that you guys can all see it. All right. So what we're looking at here is, let's go this way. All right. So what if you were saying, hey, I want to increase my buying power? And I'm going to go quickly. So if you were buying a $400,000 home without using Dream for All, you'd have a payment of about $3,300 if the rate was at 7%. Rates are tickling 7% again. Okay. And you need about $26,500 to close. If you said, John, I want to use less, I want to increase my purchase price. Well, you can go FHA. FHA has a little bit lower interest rates and you can bump your purchase price to $410, but you need a little bit more cash out of pocket to have the same monthly payment. So now you say, but what can I do with Dream for All? Here's what you can do with Dream for All. You can buy a $500,000 home. You are paying the same $3,300 a month, and all you're paying for is the closing cost, which is about $23,000 on a $500,000 home. Okay, you're looking at around 4% of the purchase price if you are putting your own money, your own down payment. Excuse me, if you're paying your own closing costs. If you're financing in the closing costs, you're looking at more closer to 4.5% to 5% because part of those closing costs is the mortgage insurance. Now, you also have an option to have no cash needed by having the Dream for All program pay for some of your closing costs, which would take a little bit off of your purchase price, but you could buy a $480,000 home. And instead of needing $23,000, you only need about $1,300 to purchase the home. So it stretches your buying power significantly and decreases the cash you need to purchase a home. Now let's look at how it works to lower your payment. Let's say you're in the other boat and you're saying, hey, John, I want to buy a $500,000 home, but I don't want to spend $4,200 a month with a 3% down payment conventional loan. Well, you can go to FHA, and FHA has a little bit lower interest rate, so it saves you about $130 a month. Or you can use Dream for All. Dream for All on a $500,000 home, your payment drops by $876 a month, and your cash to close went down. Instead of needing $33,000 or $34,000, you only need $23,000. Or you can get in with next to nothing. You can buy that $500,000 home. You're still saving $710 over what you would have spent on the traditional conventional loan, and you only need $1,100 to purchase the home. This right here is the power of the Dream for All program because it gives you so much flexibility. It gives you so much opportunity to leverage other people's money. That's what this is all about, leveraging other people's money. In this case, it's money from the state of California. Now, let's talk about if you're under 80% of the area median income. I'm not going to go through what that is per county, but if you're at the lower end of the income range in your county, you get a couple extra benefits. You get a lower minimum credit score. You only have to have a 660 credit score, and you get a little bit lower interest rates. I'll show you an example of what today's interest rates look like in a minute. You also only pay back 3/4 of what the appreciation amount is that other people pay. So if you take the full 20%, and you're under 80% of the area median income, you're actually only paying back 75 cents on the dollar. In other words, 15% of the appreciation instead of 20. And you have cheaper mortgage insurance. That only applies if you're, well, in this case, we're always putting less than 10% down. All right, who qualifies? You must be a first-generation home buyer. It's a conventional loan only. You have to occupy within the first 60 days, and you have to stay there for at least a year. You cannot use co-signers. So you cannot have a family member or a friend co-sign with you. Now, there is a loophole. If you have a wealthy family member or someone who has a good amount of assets in the bank and they have a trust, if they're willing to set you up as a benefactor of receiving monthly payments from their trust, we can count that as income. I'll explain that to you when we meet one-on-one, but it's a huge opportunity to help you qualify. If you're really close to qualifying, but you need a little bit more income, or you had to kick off a spouse because their income puts you way over the income limits, finding someone who's willing to pay you a trust payment for the next 3 years out of that family trust. Maybe you have a parent who has money that they're going to give you, not that they're a homeowner, or maybe they are, but it's your spouse who qualifies as first generation. Don't mean to confuse the issue. But you can have that person give you an early inheritance. Maybe it's a grandparent who has some money, and they can give you an early inheritance by paying you monthly out of that trust. I can count that as income. All right, couple of questions here. Actually, let me finish this real quick and I'll get to my questions. You have to have at least $1,500 to $3,000 to spend. Even if I get you in with zero, you've got to have money to pay for the appraisal, the inspections, the credit report fee, and your earnest money deposit. 680 FICO score, unless you're lower income, in which case you can have a 660 FICO score. All right, couple of questions here that we've got. All right, Aruna says, do you need to pay back to the state? You absolutely have to pay back the state. You pay back the state 20% of what the house sells for. So you pay them back. That includes the money that you borrowed and 20% of the appreciation. George asks, must this be a single family home, condo, or halfplex? Yes. Actually, it can be a manufactured home too. What it cannot be is it cannot be a 2, 3, or 4 unit property. So it can be a single family home. It can have an ADU, as a matter of fact. We just can't be counting rental income from the ADU. Fannie Mae doesn't participate in counting rental income from the ADU, but it's got to be a 1-unit property. So that's a condo, a townhouse, a single family residence, a halfplex, or a manufactured home on a permanent foundation. But the rules are a little tighter. The debt to income ratio rules are a little bit tighter, and the cost is, actually, the cost isn't going to be really any different. So no difference there. All right. So guidelines, we talked about the debt to income ratios. Actually, let me explain to you really quickly. We are going to calculate your debt to income ratio, and there's different layers of how we look at it based on your credit score. So I'll go into this for you in great detail as we work on your pre-approval, as James or Gustavo or I work on your pre-approval. We're going to go through this with you, but we look at everything. So your debt to income ratio, if your credit score is over 700, if your credit score is over 700, then, and let me get rid of George's question here. All right, if your credit score is over 700, we can allow you to spend half of your gross income, but it's the gross income I'm using on the application, and we multiply that by 50%, and then we subtract out your car payments, your credit card payments, and your student loans. That equals your maximum house payment. That's a number that I'm going to calculate with you to say, this is the most that you can spend based on the income that we are using. By the way, I want to make it really clear. Do not assume you make too much money. Don't use last year's W-2s and say, oh man, I make too much money. Don't use last year's W-2s and say, oh man, I automatically qualify based on the income limits because I make under the threshold. We calculate what you're going to make within reason. So we look at the history of the last 2 years to predict the next 3. And I have a whole video I did for about 20 minutes on my Dream for All YouTube channel. And I talk more about how the mistakes people make in looking at their income. So just be careful in assuming you don't qualify or that you do, because the rules are very specific on how we look at this. All right, property information. So it does have to be a single family residence. We talked about this already. Manufactured housing is permitted. Conventional loans, I don't know why this slide's playing out different, but we can go up to $766,550 for the loan amount. Now be careful misunderstanding the purchase price versus the loan amount. If you're over $750,000 purchase price, the most you get is $150,000. But essentially, you could buy a $900,000 home, putting $150,000 down, a little bit more than 150. And actually, anyway, that's not 150, but that's $180,000. But you can put part of your own money down. So you say, hey, John, I'm only getting 150 from the state, but you can put some of your own money towards it so that you're still under that conventional limit. Or if you're in a high balance county, you can go over that limit. I have another video I have on my Dream for All YouTube channel that goes more into detail on that. And most importantly, you get to pick the property. There are some down payment assistance programs out there that are specific to certain properties, and you have to buy one of those properties. This program, you pick. It's any property that you want. So what do you need to do to get prepared? First of all, number one, your credit score must be in line. So 680 is expected. I said here, let us do a soft credit. The reality is we can't use soft credit for Dream for All because we have to get a full pre-approval. So we do need to get a hard credit. So that is inaccurate on here. You need to save up for your earnest money deposit, your appraisal fee, and your inspection costs. I talked about that a little bit earlier. Know your numbers, know your payment budget and your price range so that you can start looking a little bit, didn't mean to do that, so that you can start looking with your realtor and narrow down an area you want to buy in. You can start talking to your realtor now. Do not have them go out and show you a whole bunch of homes because look, those homes aren't going to be on the market in June when you have the opportunity to use this money. But you still want to get an idea of what the market looks like, what cities you think you're going to buy in, what counties you might want to buy in, et cetera. Home buyer education is required. There are 2 courses you have to take. The first is an online course, costs $99. Only one borrower has to take this course. And it is an 8-hour course, including a 1-hour-long one-to-one session. It's good for a year. So if you did it last year, it might expire. It's likely to expire. We had a huge rush of people doing it between March, April, and May of last year, but it's only good for 1 year. So the good news is you don't have to rush to go do your education this time because you do not need the education to submit your reservation request into the portal. Then there's another education that's required. That is the shared appreciation. It teaches you about how this shared appreciation works, so you understand what you're paying back to the state. That's free. You can take it now. It's online with CalHFA. Easy to do. No rush this time. So no need to stress yourself out and saying, how do I get this done quickly because I need it in order to submit your reservation? You do not. All right. So the last thing I'm going to talk about, and then I'm going to take more questions. So we have about 5 minutes left if I'm going to end on time. And I like to end on time, but I can stick around a little longer if we need to. But if you have questions, post them now so that I can get to them in the next couple of minutes. So the first question people say is, should I just buy now? Well, first of all, if you buy now, you don't have to share any of your appreciation. Like, you get 100% of what the house sells for down the road. I have 6 different ways to buy a home with 0 down payment. So if you're saying, John, I can't buy now because I don't have down payment money, I have 6 different ways to buy a home with 0 down payment. And you don't need to hope for the lottery. You have a less than 1 in 10 chance of winning. So when you meet with me, I'm going to give you 2 pre-approvals. I'm going to give you your Dream for All pre-approval, then I'm going to give you your Buy It Now pre-approval. That's an option where you can pull the trigger now. You don't have to use it, but it's there so that you understand what the options look like. And by the way, did I mention less competition? Gang, we saw interest rates drop in January, and we saw so much competition of people coming out of the woodworks, and then rates started going back up in February, and people are starting to pull back a little bit. But it proves to me people are waiting until house prices drop, people are waiting until interest rates drop in order to take advantage of buying a home. People are sitting on the sidelines saying, I'm not going to buy at this interest rate, but as soon as interest rates drop, I'm ready to buy. Guess what? That means more competition. That means more people fighting with you in order to get the offer accepted on that home. And so if you choose to take the Buy It Now option, you have a lot less competition. Now, let's talk quickly about interest rates. So CalHFA sets the interest rate. So let me make this a little bit bigger so you guys can see it easier. Here we go. All right, so CalHFA sets the interest rate. Hopefully you can read that. This is on CalHFA's website. You can view it. Every lender uses the same rates. You're not shopping lenders to say, oh my gosh, what lender is going to give me a lower interest rate? Okay, it's going to be the same interest rate no matter what lender you use because it's a bundle deal. You are getting the money from the state for the assistance and the money from the state for the big loan. You cannot take the assistance money without getting the money from the state for the big loan. It's a package deal. And so if you look on the state's website and you get to the point under lenders where it talks about rates and reservations, and you will see on that page, there is a standard rate lock and a low income rate lock. This is today. Today is February 12th. So your standard rate lock is 6.625%. Your low income rate lock is 6.5%. If you got into contract today and we met today to talk about your locking, this is what we'd have the option to lock. Once you lock that interest rate, that is your interest rate for the next 30 years. But if you cancel that property and buy something else, you lose the interest rate when we relock on the house that you actually find that you close on. So a lock is good for the house you're buying, not for you. So you can't lock ahead of time. F Sharp, I see your comment. I will put it on the screen, but I'm going to cry when I see the comment and I put it on the screen, and I don't want to cry while I'm trying to talk. So you guys will understand this in just a second. All right. So you're looking at the rate with DPA. DPA stands for down payment assistance. Okay. Down payment assistance is what that stands for. So you are doing a loan with DPA. All right, let's keep going here. I think I'm just about done. I am. So we're going to talk quickly about next steps. Oops, let's go page up really quickly. And let's go this way to make me bigger. So again, you've got the team here. So whether it's me, Gustavo, or James, we are here to take great care of you. Take a screenshot or a picture of this screen right now. Cool. So you got me in a great pose. So you have all of our information so that you can reach out to us. I'm going to give you a little bit more direct information. If you want, this is only to my application, but if you are saying, hey, John, I don't know who to work with and I want to start the process, this is the fastest way to start the loan process. Elizabeth, I see your question as well. I'm going to get to that before F Sharp, because when I post his comment, he's going to make me cry. All right, so you can scan that QR code or go to apply.johnloanking.com to get started with me. If you want to help your family figure out more about this, share this video with them, or you can send them to this QR code, and there's a video series all about the Dream for All program So we'd love to help spread the word and get as many people out there. So you can also visit us at californiadreamforall.info. Again, there is the QR code. I'm going to pull up the questions. So Elizabeth says, for low-income folks, they actually get a lower interest rate. Yes, they absolutely do. So let's go back to that slide really quickly here, and you will see that low income, you're getting now some days, the low income interest rate is actually the same as the normal interest rate. So I'm not promising you that it's always going to be a lower interest rate, but yes, if you are low income, you qualify for a reduced rate. It's just a question of whether the rate is actually reduced that day. I'm going to put us back to this slide so you can have all of our contact information, and let me close this so that you don't lose James's information. All right, so guys, we are right at a couple minutes after 8. I'm 1 hour in. If you have any questions, post them right now. Otherwise, I am going to say thank you to James and Gustavo and for everybody who's been here today. I appreciate it and look forward to really helping you. As I said, James, Gustavo, myself, we are interviewing for the right to be your lender. We are going to guide you well. We're going to help you navigate these waters and help you make the right decision for you. All right, so on a sour note, yes, my 49ers lost yesterday. Yes, I cried myself to sleep last night. But the good news is I woke up this morning and it's a new day. It's a new dawn. It was a great game. Honestly, I haven't seen a better Super Bowl game. So I am super happy. I hope that you guys enjoyed the game yesterday. F Sharp, thank you for putting your finger in the wound and pushing it around a little bit. But anyway, I really appreciate you guys. I appreciate you listening. Again, I'm going to talk for another 30 seconds. If you have a question, post it now. Otherwise, I'm going to sign out in just a minute. But guys, just know this process, it isn't guaranteed, but it's one of the best opportunities to become a homeowner. And so if you're feeling like, man, I feel almost discouraged, John, don't feel discouraged. You literally have, yes, it's a lottery. By the way, the state came back and said we're not allowed to call it a lottery because there is actually a state lottery and this is not it. But yes, it's not a sure thing, okay? But it gets you one step closer. It gets you started in the process. And the funny thing how momentum works. Momentum gets you going because home ownership is something that is critical to wealth building long-term. And too many people are sitting in the corner saying, I don't even know where to start. So if you're one of the 90% of the people who don't get their voucher accepted, you at least know where to start. You've been through the process. You've kind of tore off the Band-Aid a little bit and you've said, okay, it's not as painful as I thought it would be. And I actually can become a homeowner. That's critical. So don't lose that opportunity to give this a shot. And guess what? 10% of people are going to get it. It could be you. All right. A couple last comment. Annie, excuse me. Thank you so much. I appreciate your knowledge and time. Annie, I am happy to provide it. I really appreciate you guys. Please share this with anybody that you know, regardless of what site you're on, what platform you're watching it on. Please click share. If you're watching in the webinar platform, you can go to any of my YouTube or Facebook pages. Just search John Lone King and share this, and we would really appreciate it. So everybody, have an absolutely wonderful Monday night. We'll talk to y'all soon, and call me so we can get this set up and help you make your dream come true. Thanks, everybody. Bye-bye.